let's talk about like some of the like winning strategies. Basically, like, so let's talk about things that people are doing right to get deductions. Like, for example, like one of the things that worked for me was I bought a $4 million commercial building, an apartment complex, and I got something called accelerated depreciation, and that actually helped me tremendously. So would you mind elaborating on that? And then also maybe elaborating on a few other things that maybe aren't as obvious that your customer or people are doing to benefit in terms of taxes.
Yeah. So the one you mentioned is a very, very useful and powerful tool, accelerated depreciation. But how does it happen? So when you own a real estate, especially when you own commercial buildings or even larger multifamily units and things like that, this becomes phenomenal. But the cost segregation study is the gateway to having a lot of that accelerated depreciation come through. What is that cost segregation study? We talked about depreciation. It's when you have the purchase property, the purchase price divided into X amount of chunks, and that's the deduction that you get to take every year. The cost segregation study comes along and it says, well, hold on, pump the brakes. We know there are pieces of this building that are not going to last 27 and a half or 39 years. So we need to segregate, hence the name segregation. We need to segregate those components out. Things like air conditioning, roofing, some of those other pieces that we know we have to replace within a, 5, 7, 15-year time frame. It segregates them out and then reclassifies their useful life. The whole building has a useful life in commercial for 39 years, but these different components can be reclassified and have either a 5, a 7, or a 15-year life. That's the cost segregation study. Now, accelerated depreciation, or some people call it bonus depreciation, under the Tax Cut and Jobs Act from President Trump, said that, hey, these particular classes, you don't have to wait the entire 5, 7, or 15 years to depreciate them. We'll allow you to take the whole deduction right away in the first couple of years. So imagine that, a $4 million building, which you would normally spread out over 39 years, probably somewhere around 1.5 to 2 million of that can be accelerated and drops on the first 3 to 5 years. That completely changes your tax situation. $1 million deduction right there. Easy.
Yeah. And that's exactly what happened to me. I even sent it to some friends because basically, just to give another example, let's say you make 500,000 in your real estate business. And let's say you get let's say you make $1 million in your real estate business. And let's say you get $1 million deduction. It basically wipes out the entire gain for federal purposes, not for state purposes, right? For federal purposes, which means that if you have the paper loss of $1 million and you made $1 million, it means for federal taxes, you, in other words, wouldn't pay any taxes. So for me, that was a big, like, mind blown because I'll give you another example, Larry. My dad brags to me. He's like, well, I have a ranch. And because I lose money on that ranch, I get a write-off because I lose money. And then I told him, I'm like, Dad, that's a physical loss. You're actually losing the money, meaning money is coming out of your pocket versus a paper loss. On a paper loss, it's just on paper. You didn't actually lose the money. It's basically a write-off.